So, hi everyone, this is Karen Perales, and now we're going to tackle or talk about the basic accounting and financial statement. So, basic accounting is a process of recording, summarizing, analyzing, and reporting the financial transaction related to a business. It explains how a business organization records, organizes, and report this transaction to regulators and other parties. And financial statements are written records that convey the business activities and the financial performance of a company. Financial statements are often audited by government agencies, accountants, firms, etc. to ensure accuracy and for tax, financing, or investing purposes. The financial statements are used by investors, market analysts, and creditors to evaluate a company's financial health and earnings potential. And the three major financial statement reports are the balance sheet, income statement, and the statement of cash flow. So first is the understanding the balance sheet. The balance sheet provides an overview of a company's assets, liabilities, and stockholders' equity as a snapshot in time. The date at the top of the balance sheet tells you when the snapshot was taken, which is generally the end of the fiscal year. So the balance sheet formula is the asset is equal to liabilities plus owner's equity. The balance sheet totals will be calculated already, but here's how you identify them. First, locate total assets on the balance sheet for the period. Total all liabilities, which should be a separate listing on the balance sheet. It may not include contingent liabilities. Locate all shareholders' equity and add the numbers to total liabilities. And lastly is total assets should equal to total of liabilities and total equity. So data from the balance sheet. The balance sheet identifies how assets are funded, either with liabilities such as debt or stockholders' equity, such as retained earnings and additional paid in capital. So item included in the balance sheet. Below are the examples of items listed on the balance sheet. First is the assets. Cash and cash equivalent are liquid assets, which may include treasury bills and certificates of deposit. Accounts receivables are the amount of money owed to the company by its customer for the sale of its product and services. And lastly is the inventory. Next is the liabilities. Debt including long-term debt, wages payable, and dividends payable. So last is the shareholders equity. Shareholders equity is a company's total assets minus its total liabilities. Shareholders equity represent the amount of money that would be returned to shareholders if all of the assets were liquidated and all of the company's debt was paid off. Retained earnings are parts of shareholders' equity and are the amount of net earnings that were not paid to shareholders as dividends. So now let's move on to the second financial statement, which is the income statement. Unlike the balance sheet, the income statements covers a range of time, which is a year for annual financial statements and a quarter to four quarterly financial statements. The income statements provide an overview of revenues, expenses, net income, and earnings per share. It usually provides 2 to 3 years of data for comparison. So income statement formula and calculation is net income equals the revenue minus expenses. So first is total all revenue or sales for the period. Second, total all expenses and costs of operating the business. Third is subtract total expenses from revenue to achieve net income or the profit per period. So data from income statements. An income statement is one of the three important financial statements used for reporting a company's financial performance over a specific accounting period. Also known as the profit and loss statement or the statement of revenues and expense. The income statement primarily focuses on a company's revenue and expenses during a particular period. Once expenses are subtracted from revenues, the statement produces a company's profit figure called net income. So types of revenues. Operating revenues is the revenue earned by selling a company products or services. The operating revenue for an auto manufacturer would be realized through the production and sale of autos. Operating revenue is generated from the core business activities of a company. Non-operating revenue is the income earned from non-core business activities. These revenues fall outside the primary function of the business. Some non-operating revenues example includes interest earned on a cash in the bank, rental income from a property, income from strategic partnership like royalty payment receipt. Last is the income from advertisement display located on a company's property. So now, let's move on to the types of expenses. Primary expenses are incurred during the process of earning revenue from the primary activity of the business. Expenses includes the cost of goods sold, selling, general, and administrative expenses, depreciation or amortization, and research and development. Typical expenses include employee wages, sales commission, and utilities such as electricity and transportation. Expenses that are linked to secondary activities includes interest paid on loans or debt. Losses from the sale of an assets are also recorded as expenses. The main purpose of the income statement is to convey details of profitability and the financial result of business activities. However, it can be very effective in showing whether sales or revenue is increasing when compared over multiple periods. Investors can also see how well a company's management is controlling expenses to determine whether a company's effort is reducing the cost of sales might boost profit over time. So now let's move on to the third major financial statement, which is the cash flow statement. The cash flow statement, or CFS, measure how well a company generates cash to pay its debt obligations, fund its operating expenses, and fund investments. The cash flow statement complements the balance sheet and income statement. So data from the cash flow statements. The CFS allows investors to understand how a company's operations are running, where its money is coming from, and how money is being spent. The CFS also provides insight as to whether a company is on a solid financial footing. There is no formula per se for calculating a cash flow statement. Instead, it contains three sections that reports cash flow for the various activities for which a company uses its cash. Those three components of CFS is listed below. So first is the operating activities. The operating activities of the CFS includes any sources and uses of cash from running the business and selling its products or services. Cash from operations includes any changes made in cash, account receivable, depreciation, inventory, and accounts payable. This transaction also includes wages, income tax payments, interest payments, rent, and cash receipt from the sales of a product or services. Second is the investing activities. Investing activities includes any sources and uses of cash from a company investment into a long-term future of the company. A purchase of sale of an asset, loans made to vendors or received from customers, or any payments related to merger or acquisition is included in this category. Also, purchase of fixed assets such as property, plant, and equipment, or the PPE, are included in this section. In short, changes in equipment, assets, or investments related to cash from investing. Lastly is the financial activities, financing activities. Cash from financing activities includes the sources of cash from investors or banks, as well as the uses of cash paid to shareholders. Financing activities include debt issuance, equity issuance, stock repurchases, loans, dividends paid, and repayment of debt. So now let's talk about the financial statements limitation. Although financial statement provides a wealth of information on a company, they do have limitations too. The statements are open to interpretation, and as a result, investors often draw vastly different conclusions about the company's financial performance. For example, some investors might want stock repurchases, while other investors might prefer to see the money invested in long-term assets. A company's debt level might be fine for one investor, while another might have concerns about the level of debt for the company. When analyzing financial statements, it's important to compare multiple periods to determine if there are any trend, as well as compare the company's result its peer in the same industry. So that would be all for the basic accounting and financial statements. So now let's move on for our second topic, which is the financial projection ratios analysis. So this is the financial projection ratios analysis. First is the profitability. Net income multiplied to revenue. Efficiency. Revenue multiplied to assets. Liquidity. Current asset times current liabilities. Leverage is liabilities multiplied to assets. So first is the profitability. Profitability is the ability of the business to generate profits from its revenue and is indicated in the financial projection template by the net profit margin ratio. So net profit margin ratio is equal to net income multiplied to revenue. The ratio is an indicator of how well a business can control its cost in relation to its revenue. The higher the net profit margin ratio, the more profit it earns from its revenue. Then a negative ratio indicates the business makes a loss. When completed, the financial projections should show a positive net profit margin ratio which increases year on year and is consistent with the industry in which the business operates. So next is the efficiency. Efficiency is a term used to indicate the ability of the business to perform effectively and utilize its assets to generate revenue, which in turn generates profit. The financial projection template indicates efficiency using the ratio of revenue to assets, sometimes referred to as the asset turnover ratio. So asset turnover ratio is equals to revenue multiplied to asset. The higher the asset turnover ratio, the more efficient the business is at generating revenue from its asset base. So note, from the accounting equation, we have asset is equals to debt or liabilities plus equity. And so the ratio also measure how efficient the business is at generating revenue from the total debt and equity funding used in the business. The calculation and use of ratio is more fully discussed in our asset turnover ratio tutorial. So the rest of the financial projection ratio analysis will be discussed by Ms. Maika May Olisiman. Thank you.